Hello and welcome. I'm Real Crowd CEO Adam Hooper, and this is the Real Estate Investing for Your Future podcast. Here we explore the latest in commercial real estate trends, insights, and investment strategies that passive investors can use to build real estate portfolios that last.
All opinions expressed by Adam, Tyler, and podcast guests are solely their own opinions and do not reflect the opinion of Real Crowd. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. To gain a better understanding of the risks associated with commercial real estate investing, please consult your advisors.
Our special guest today is Mat Sorensen, CEO and attorney at Directed IRA and Directed Trust Company. Mat has been at the forefront of the self-directed IRA industry since 2006. He's also the best-selling author of the Self-Directed IRA Handbook, an authoritative guide for self-directed retirement plan investors and their advisors. Boy, that's a mouthful, but it's a great read. In today's conversation, Mat discusses what you need to know to invest your IRA money into real estate assets. I hope you enjoy today's conversation with our guest, Mat Sorensen. Well, Mat, thank you so much for joining us today. We were talking before we started recording. I think it's been over 2 years since we had you on the show last. So thank you for coming back and sharing what's going on in the self-directed IRA and 401k space today.
Yeah, I guess I'm like a second-time caller or guest on the Real Crowd podcast. Not long-time listener, second-time caller on the Real Crowd podcast.
So before we jump in, why don't you tell us a little bit about your background, what you guys do, how you help people access their retirement funds, and then we'll dig into the conversation.
Okay. Yeah. So, our company, Directed IRA, that's my company. We help clients use retirement account dollars to invest in alternative assets. The number one being real estate, crypto's kind of the number two out there now, at least in the current market, but real estate still dominates. And that's the most popular alternative asset. It's kind of the tried and true thing for our clients over the years. So we basically help clients use IRAs, 401ks, HSAs, any type of retirement account where they don't want to just buy stocks, bonds, or mutual funds, but they want to invest in, let's say, a real estate deal. And so that's our business. We don't help them find the deals or sell them investments. We just are like the Schwab, so to speak, for the retirement account to say, all right, you go decide what you want to buy. We're not your advisor, but we're going to handle your account, make sure the rules are followed. And so that's what we do. And I got into that in 2006. It seems so long ago. As a lawyer, the first client of mine that asked me if he could use a Roth IRA to get an option on a piece of real estate. So yeah, that's what I do.
And now, again, I think we want to get to more of the practical. What does this actually mean for investors, and how can they tap into that? But it's been so long since we've had you on. Let's do a little bit of kind of setting the foundation of what does that actually mean, right? What is a self-directed IRA? How's that different from a traditional? Who can use that? Just maybe take us through 30,000 foot on what that means.
Yeah. So a self-directed IRA is really a retirement account that can invest in any asset allowed by law. And a lot of people are surprised to hear, wait, my IRA could invest in a private fund that owns a large, real estate deal, or it could buy the single family rental down the street, or it could own an Airbnb property. Yeah, like your IRA can own that. The problem is, like, the financial services industry, when retirement accounts came out, like, the Morgan Stanleys or Merrill Lynch or Fidelity or whoever it is, they realized, wait a second, people are putting lots of money into these retirement accounts. They love the tax perks. They love the tax deductions on the traditional accounts. They love getting the money out tax-free on the Roths. And Americans just started saving in those accounts more than any other place. And so if you're in the financial services industry, you want to handle those accounts. What are you going to let those accounts invest in? What you already sell. Those financial services companies already sold stocks, bonds, and mutual funds. So surprise, when you open an IRA account there, what are they going to let your account invest into? What they sell. They already do that. That's their business. So now you've always been able to buy real estate with an IRA. So a self-directed IRA is just kind of like an industry term. It's not in the tax code. Retirement accounts, all retirement accounts have been able to invest in real estate, let's say. The problem was the institutions that handled the accounts restricted you on what you could buy. So if you were at Fidelity, they're like, well, we're a financial services company. You can buy what we sell. If your IRA is at New York Life, they're like, well, we're an insurance and annuity company. Your IRA can buy an annuity. So you need to use with these quote unquote self-directed IRA custodians, which is what we are, where we provide accounts, and we have 30 competitors, but our company, Directed IRA, is number one, baby. And
Mhm.
but we provide those accounts to people who are like, all right, I want to invest in a real estate deal. I want to invest in a little LLC or limited partnership doing a deal. I want to buy crypto or the next startup or whatever someone's interested in.
And so how does that I guess maybe what's changed, I guess, since you said you started in 2006, right? It's been a couple
Yeah.
years since we've been on. How has that changed? I think from our perspective and where we sit, it's still an awareness thing, right? I think it's just
Yeah.
making it known that people can do this, and I think there's some parallels with our industry and what we deal with on the sponsor side of, what does it mean to raise capital through a platform or online? There's still an education process. So I'm just curious, maybe how have you seen the awareness of this change since you got started, and are there any
Mhm.
technical or fundamental changes to that model or to the business over the last decade, handful of years?
Yeah, so the industry has grown significantly. So the amount of people doing it in 2006, you know, may have been in the hundreds of thousands to now that we have millions of people with self-directed accounts. And it's
Hmm.
still, 2% of the retirement plan market, maybe. But, that's a $30 trillion market. There's no more
Hmm.
cash to be invested in anything and then US retirement accounts. So if you're someone raising money for deals, like you need to know these rules because it's more likely the people you're talking to are going to have money in a retirement account than they are in a savings account.
Hmm.
And so this is just where we've been taught as Americans to put all your money and save for the long haul. Just max out your 401k, throw money in an IRA. And so, you know, 30, 40 years down the road now, actually 50 almost since ERISA was passed and IRAs and 401ks were created. I mean, 50 years down the road, it's just that's where all the money is. And
Hmm.
so what's happened too, there's been a couple of just structural things that have made it grow. One is the baby boomers have like moved and left jobs and have huge retirement accounts. So, they've got 500, 300, a million plus in 401ks. And now they've left that employer they built that up with over the years, and they can roll out of that 401k to an IRA. See, a lot of people, let's say you're 40 years old and you got a 401k at your work that you've been at for 10 years, and you're like, all right, I got a few hundred grand in here. I'm kind of bored with buying mutual funds. I'd like to invest in a real estate deal. The problem is that 401k locks you down to whatever investment options they have, and you can't
Hmm.
move the money to a self directed IRA until you leave or retire, or you can hit retirement plan age of 59. You can roll it out too. But so we've had a lot of people like have job changes, but have large accounts grow. That's been a huge shift that's created large self-directed accounts to invest in alternatives, plus just the internet. I mean, people
Hmm.
just learning they can do it. The financial services industry controlled the conversation. And so even today, we still run across clients who call their financial advisor and are like, all right, I want to invest in this. And the financial advisor is like, you know, freaks out on them that this is insane and they shouldn't do it. And, and the financial advisors it's if they're even if they're an RIA, they got a little work to do because it's more difficult to
Hmm.
execute that type of deal than it is to like click a button and buy Apple. So so I think the financial service industry's kind of crapped on it. But what's happened is the demand from investors and the clients forces it to grow because
Hmm.
they want to invest in this stuff.
And so if someone has, like you said before, right, the bulk of America's capital is in retirement accounts. If someone
Mhm.
has funds that are in a savings or in a taxable non-qualified account,
Mhm.
w- where should they be prioritizing one or the other? I know obviously we can't give tax advice on the show here, but
Yeah.
generally, how do you see that decision-making process of if there's multiple sources of funds? What are the benefits of doing it through their qualified money, their IRA or 401k rollover versus a taxable account?
So we always look at it, and I think it's not an either or. I really
Hmm.
do. I mean, because even myself, I think of myself, I invest my personal funds into real estate. I invest my personal funds in the market. I invest in the crypto. I'm doing different things there. I do the same thing with my retirement account. Some people say, and I don't agree with this, some people say, well, I want to invest in real estate with my personal funds because I want all the tax benefits. Well, if you're a high income person making more than 150 grand a year, the only way you're getting tax losses that can offset your other income is if you're a real estate professional. And so, from the tax standpoint, a lot of these real estate losses people seem to chase on their personal funds, which I get it, can be good. They never see it anyways. Because in a retirement account, what happens is if my IRA buys real estate, it doesn't pay tax, so there's no depreciation loss. But a lot of people are fixated on that and say, but I want that depreciation loss to offset my personal income. Well, this is in your retirement account. It doesn't hit your personal tax return. So
Mhm.
there's no depreciation loss. But remember, there's no tax either on the income. So, I mean, think about it this way. If I bought, the way the retirement account rules work, you buy Facebook stock for $100,000 and you sell it for $150,000. That $150,000 gain goes back into your retirement account. You pay no tax on the 50,000 gain. But when I buy a house, the same thing. Let's say I bought a real estate deal. I don't care, just a duplex. I don't know, for 100 grand, and I sold it for 150. Well, that 50,000 gain goes back into the retirement account. You don't pay tax on it either. So you get the same no tax when you're making money and growing the account
Mhm.
in the retirement account than you do with stocks. As you're buying real estate, same deal for stocks.
And now, what are some of the, I guess, I mean, are there downsides to doing it through a self-directed account that you might not have in a taxable?
Well, in a retirement account, one thing you got to look for is if there's debt involved.
Mhm.
And this is for IRAs. But any IRA or even HSA, this is traditional or Roth, when it's investing in real estate that's leveraged with debt, there's a tax on profits from the debt. And it's called UDFI, unrelated debt finance income tax. So when I said earlier, if I bought a property for 100 grand and I sold it for 150, if my retirement account bought the property with cash or I invested in a partnership, let's say an LLC with a bunch of other people, and we didn't have debt on it, we sell it for 150, there's no tax on the gain.
Mhm.
But if I brought debt into the deal, and let's say just so I can do the math, I'm going to keep it at 100,000. I realize this may be a million or 10 million, but so let's just so I can do the math. Let's say it's $100,000 purchase, but you put in 40 grand from your IRA, or you and other partners and people in the deal, other investors essentially put in 40 grand to buy the property. And then you go get debt for the other 60,000. Let's say you then sell it for 150. There's a $50,000 gain and you get to write off any expenses, of course, at sell, but let's say it's a net $50,000 gain. Well, the IRS looks at that and says, well, 60% of this deal was debt. It was not retirement plan dollars. It was not capital invested. It was debt. And we're going to tax the debt that leveraged the IRA's purchasing power. So if their IRA put in 40 grand and got a loan for 60, they look at that as that 60,000 was not retirement account dollars. You don't get
Mhm.
tax-free treatment on profits from that. So on a $50,000 gain, you have to take into account the debt that you put into it, which was 60% of the deal. So 60% of that 50 grand would be subject to this UDFI tax. So that would be, I think, 30,000 in that
Mhm.
example. And then the UDFI tax on a sale of a property is the capital gains rate, 20%. 20% of 30 grand is 6. So you'd end up, the IRA, I should say, not you, the IRA would end up paying 6 grand on it. So that's probably the biggest downside is
Mhm.
properties leveraged with debt that your IRA is investing. Now, despite that, we have plenty of clients that invest in leverage deals like that because the total return is better than the next best thing their retirement account can invest into. If they say, well, Matt, after that return I can get on the deal, even paying, a little bit of tax, 20% capital gain, let's say, on only the piece that's debt leveraged, I'm still ahead of the crappy mutual fund I've been in. So, you know, so we want to look at the net return at the end of the day because the goal is to just get the biggest retirement account, right? Have
Right.
the largest
Right.
account at the end of the day. So you just kind of got to run the math, do the numbers, so to speak, on what you think your total return is going to be. And that's when I think someone should look at using their retirement account to do this. It's not like, should I use personal dollars or retirement account dollars? a lot of times people's personal dollars are frankly more tied up
Hmm.
than their retirement account dollars. And they have a lot more leeway to use those retirement account dollars. So what I tell those clients is, and we're not financial advisors, but I just tell them just from a basics. Well, what else is your retirement account invested in? What's it invested in now? Or what's your next best investment you would make? If this real estate deal is a better deal, even if it's leveraged with debt and you got to pay some UDFI tax from the IRA, are you ahead of the game? And if so,
Hmm.
then that's an investment you should consider.
And that's something that we've seen too, is the time horizon of retirement funds generally align well with longer term, typically a longer term lens in real estate investments, right?
Mhm.
If you don't need to touch that money for 10, 15, 20 years, you can lock a lot of value in real estate by holding it longer term. That's generally how more investors look at the asset class is on a longer term horizon, which tends to track well with not needing to touch those retirement dollars for usually a longer period of time.
Exactly. And I think sometimes with personal funds investing in a real estate deal, unless you got a significant asset base, a lot of times people run into issues where they're like, crap, I need to sell this interest. Well, it's in a private deal that's a real estate deal that's illiquid. It's not like you can just get out
Hmm.
of it, in 6 months if you want to. So, um, so you're right. I think the retirement accounts have that long-term hold trajectory anyways. We're investing for the long haul. We're using the money for later in life and retirement, and it does align well with more of a long-term strategy of real estate.
Hmm. And now you mentioned the capital gains issue. We'll I guess somewhat timestamp this recording here late in April in 2021.
Yeah.
Um, Rumblings coming around of cap gains going up. Certainly, we've
Yeah.
seen up to as high as almost 40%, right? That's a pretty substantial increase.
Oh my
Um,
gosh, I know. It's such a bummer. Keep going.
how I was gonna say, I mean, how do you have you seen much of a reaction yet, or I guess how do you guys look at that? I mean, obviously, tax policy always changing depending on administrations.
Yeah.
Um, how
Yeah.
much of that plays into this decision-making process, and have you guys seen any kind of a reaction, or I would assume that would increase desire to do these kinds of investments in qualified accounts with retirement money rather than
Right.
being subject to who knows what that cap gains rate might be in the future.
Yeah, and in addition to that, Biden is proposing getting rid of the 1031 exchange.
Oh, yeah,
So
that's
it's not like
that's been on the
what's that?
docket for 20 plus years.
Yeah,
So
yeah,
so
yeah.
we'll see.
So, but he's
That one's
tearing that up. So it's
yeah.
like if people are thinking, oh, it's a 40% rate, I'll kick the can down the road by doing a 1031 exchange. No, you're not. That's going to go at the same time. So, I mean, if his proposal passes, so um, yeah, I mean, there's obviously from our clients, because our clients, they and for the most part are account holders, that are investing in real estate with their IRA. They do it on their personal side too. But it is going to make retirement accounts that much more valuable because the
Mhm,
dollars you have in a retirement account, you do not pay capital gains tax when you're buying and selling, real estate assets or stock or private companies or crypto, whatever you're doing. There's no capital gains tax as you're making money and selling and getting gains. So if that passes, it'll frankly make the retirement account much more valuable than your personal funds.
mhm. And so now I guess for listeners that are, maybe they have a retirement account, didn't know that they could do this. Um, what does
Yeah.
that process look like? And maybe what are some of the questions they should be thinking about if they want to explore this, right? Just maybe walk us
Yeah.
through what that typical, first engagement with a new client. Hey, I've got this money in a 401k or I've got it in a traditional IRA, want to do
Yeah.
something different with it. What does that look like?
So the first thing they'll do is they'll need to move their account because let's say you're at Fidelity, and you call up Fidelity and you say, "Hey, I want to invest my IRA into this LLC or this limited partnership, or I want to buy the duplex down the street." Fidelity is going to be like, "Nah, you can't do that." And that's not because retirement accounts can't own real estate. That's because retirement accounts at Fidelity can't own real estate unless you're an ultra high net worth client with a 50 million relationship or more. And so for most people, it's like Fidelity's like, no, sorry, can't do it. So you'll have to move your account. And let's say this is an IRA or maybe an old employer 401k. You could move the account or a portion of it to a self-directed IRA at a company that allows you to make alternative investments like
Hmm.
real estate, like a private fund. And so that's what our company does, is directed IRA. So we're a trust company. We're a licensed, regulated financial institution, audited by the banking department, have to do third-party CPA audits. So like, being a company like ours is pretty tricky. It's not like you just go get an LLC from the state. So you would go to a institution that allows for self-directed accounts. And there's, like I said earlier, there's like 30 companies in our space, but our company, directed IRA, really do feel is the best because we know what we're doing and have the best service. But so you'll tell Fidelity, hey, move my money over to this new IRA account I have at directed IRA. And then we receive the funds here in an account. And then you instruct us to say, all right, directed IRA, I want to buy the duplex on 123 Green Street, or I want to invest in XYZ LLC that's buying an apartment building. And then we'll take that money from your IRA per your direction and invest it into the deal. And we'd obviously want documents on the fund that you're going into, or the real estate documents if you're buying the real estate directly yourself with the IRA.
Mm-hmm.
So it's really kind of like it's kind of like a 3-step process. What we say: open the self-directed account at where you want to be to go do this alternative investment. 2, get your funds over to it. So you got to tell Fidelity or whoever has your funds now, TD, whatever, move my money over to my new account at directed IRA. And then 3, it's instruct us to where you want to invest it. And then we process the investment.
And then does that look differently for a 401k versus an IRA? Or is it pretty similar?
Yeah. The only thing there's a couple catches on 401ks. One, if it's a 401k where you still work, many times you're going to be stuck. So those people typically can't self-direct unless they already hit retirement plan age. Some 401ks allow for what's called an in-service rollover, where you can move out a portion of the funds while you're still working there. But for the most part, if you're 40, let's say, with a 401k and you're still working there, that money's locked down. So that's one catch for 401k people. The other thing is, on IRAs, we are going to actually, let's say you have an IRA at Fidelity. We're going to actually request the funds as a financial institution to financial institution from Fidelity to say, hey, our client Adam's requested, to roll over 200 grand from his IRA with you to the IRA with us. And you sign an authorization with us and we process that to get it over. In a 401k, you have to instruct them to send the money to us. Otherwise, it's the same.
Perfect. When it comes time to actually make the investment, if they're investing in a partnership or maybe they're buying their own property, what does that look like? Is there anything different when it comes time to actually make the investment out of one of these accounts versus a typical process for taxable money, a savings account?
Yes. So you're going to have to work with the custodian. So let's say it was us, directed IRA. So you would have us process the paperwork. So let's say you're buying real estate or investing in a fund. The first thing is who's the buyer on the contract, or who's the subscriber investor on the subscription agreement. It's not Adam Hooper. It's Directed Trust Company, FBO, Adam Hooper IRA. That's the buyer on the property or the person or the account subscribing on the investment. And so the first thing to keep in mind is, like, you're not buying this, your IRA is. And then the second thing is your IRA custodian is going to actually process the money and fund it, and is going to get the investment income. So as returns are being paid out, that's going to go to your IRA account. And, there's spots in the subscription where typically you'll indicate, here's where to send my payout. Or if you're buying a property directly, you'll generally have a property manager that knows, all right, I got to send payments to the IRA. So, and many clients actually that buy property, that buy real estate with an IRA, have their IRA own an LLC 100%. The LLC owns real estate. That's called a checkbook IRA LLC, probably another conversation. But in practice, the biggest distinction is the IRA owns it. Things are going to go through the IRA. It's not you. You're signing and approving things, but your IRA custodian actually signs off on the documents for the investment.
And I'm assuming that's incredibly important to get set up correctly from the outset, right? I mean, is there anything like in a 1031 exchange, if the investor actually touches the cash, then that becomes taxable. That can kind of blow the exchange. Are there similar rules? And again, I guess maybe an add on that, these concept of prohibited transactions, maybe we can touch on that a little bit too.
Yeah. So with retirement accounts, there's the number one rule is called the prohibited transaction rule. And this basically means that you can't touch the money and you can't invest in stuff for yourself or for your spouse, parents, or kids. And so essentially what that means is let's say I own real estate personally. My IRA couldn't buy real estate from me personally.
Hmm.
That would be prohibited. The IRS doesn't trust your IRA transacting with you, nor with your spouse, kids, or parents. But let's say it's obviously I'm buying real estate from a third party or I'm investing into a private fund. That's pretty straightforward because as long as it's not my fund, I'm engaging with third parties. And so, yeah. So the other thing is you can't buy real estate for personal use. So it's not like you're buying a real estate you're going to live in. This has to be investment real estate, rentals, investing in a fund that's, renting it out or leasing it out or whatever their strategy is. It's just not for
Hmm.
your personal use. So, and there's more to that, I mean, even my partner and I have a podcast just on self-directed IRAs called the Directed IRA Podcast. And I got the number one book in the space that sold 30,000 copies called the Self-Directed IRA Handbook. There's more to know on that. If you're
Hmm.
like, because some people are like, well, Matt, I want to do a deal with my IRA and myself. Can I do that? Yeah, but that's a little complicated. So if you keep it clean and easy, though, yeah, I'm just investing in this fund. I don't know anyone over there. It's not me or my family, or I'm buying property from a third party. You're going to stay away from those rules and not have to know too much on them.
And again, we'll put links in the show notes to both podcast and the book. Great resources for anybody that's interested in the space for sure. Um, is there anything else that we should touch on from the investor side of this before we switch over to the manager side? And again, in terms of how to unlock this capital that people maybe didn't know they could even do this with.
Yeah, the only thing I'll say is like self-directing your IRA it's really the most underutilized tool out there for people. I think
Hmm.
our retirement accounts, it's odd that they became like the largest concentration of wealth, but it's became the laziest money for people. Like people have just
Set it
gotten
and forget it.
yeah, and that's what the retirement industry wants you to do, right? They're like, we got this, don't
Right,
worry.
right.
You're in a mutual fund and you're getting feed to death, but we got it. So, so I think what's happened is, and even the next generation, I mean, it's funny how many millennial clients we have with self-directed IRAs. I'm actually very surprised. They're very in touch with their money and
Hmm.
care, and in the sense that they're not okay just like dropping it into a fund and forgetting about it. And so we've seen, I don't know if it's generational or what, but we've seen a lot of interest in it from my generation too. I'm 40, whereas my parents' generation, they're in their late 60s. They're a little more, I mean, we have plenty of clients in that bracket, but they've been a little more just traditional, the set it and forget it type
Hmm.
mentality. So I think there's just been a lot more engagement on it, but it's one of those things that it's like, I tell people it's like playing a new board game. Like when you start self-directing your retirement account, it's not rocket science, but you do need to learn the rules. And
Hmm.
so it's just like playing a new board game. You just need to learn how to move the pieces, what you can't do. When you do this, you get that. And so once you learn that, it's the same game over and over again. And so just yeah, it takes a little bit of getting up to speed on the how the rules work. But then, like I said, it's just like playing the board game next week. You already know the rules, so you just do it.
And now
Um,
I would say the demographic trend that you mentioned there is interesting.
yeah.
In our space, right? I think a lot of the more comfortable with technology, younger, forward thinking,
Hmm.
younger demographic tends to be what we see on the
Yeah.
marketplace. And we've got like you have up and down the spectrum. Um,
Hmm.
but I think that's a trend that, and maybe this is kind of segueing into from the capital raiser side, right? The real estate manager side.
Yeah.
Um, getting in front of some of these demographic shifts, and certainly we've talked about before this transfer of wealth. I think it's something like 20 or 30 trillion dollars over the next couple of decades is going to transfer from the baby boomers down to millennials.
Yes.
Very different buying habits, very different investment behaviors, and how as a capital manager, asset manager, um,
Hmm.
how should they be thinking about this space, or tapping into some of these trends that are happening, that capital raising is going to look very different in 10, 15 years than it does today. And
Mhm.
I believe, I think, and obviously you, I think, have some conviction around that as well, that retirement is going to be a larger part of that. So what are some of those things
Mhm.
that they can start paying attention to as we look at that shift of getting access into some of this capital from a manager perspective, and what are some
Yeah.
of the things they should be thinking about?
Here's one big one that I think just goes unnoticed: inherited retirement accounts.
Mhm,
So when you talk about that 20 to 30 trillion that's going to be, or I don't forget the number you mentioned there, but this amount that's going to be transferring over to the next generation, just think of your own parents, just, what do they have? What assets do they have? And the typical American that's going to be passing on wealth to the next generation has some equity in a home. Maybe there's a life insurance policy. They keep maintaining it until later in life. And there's probably a retirement account. And you can inherit a retirement account, right? And still invest it for another 10 years now. And so we're seeing a lot more inherited accounts too. We're seeing those continue to grow because
mhm,
that next generation has been passing along, and their heirs are like getting their retirement account. Well, you can self-direct an inherited retirement account. So I'll bet a large chunk of that wealth passing on to the next generation is retirement accounts.
mhm,
So when I think for anyone raising money, or that's managing assets and needs capital, I think traditionally what they did was they're like, well, let's just go to a big pension fund that'll cut us like, a $10 million plus check. And we'll just get, because they're active in the alternative asset space. Well, okay. I mean, but typically for smaller fund operators, the pension funds aren't cutting them checks. But, it's the same strategy of, why was someone going after the pension funds on an alternative asset, or a private fund? Because that's where the money is. Well, it's also individually in accounts, and sure, you may need to do it at 50, 100, $250,000 at a time, whatever your minimum amount is. But the concept's the same, in that this is where the money is. People do view that for the long haul. It's not like they're going to be calling you next year because they want to buy a bigger house or something. Like, they know this money is for the long haul. And um, so I just think it's a very overlooked place to go,
mhm.
is retirement accounts. And some people are intimidated by it. Some people have some bad information on it, and so they just don't think that people will be interested. But I think it's one, and I've seen it from people we've worked with. We've seen so much success. I mean, we see the accounts come through here and what gets invested. I can give you some examples, but we see like significant growing interest in this space. It's the whole reason we got into it ourselves.
Yeah, and I think, we see a pretty even split, I think, between managers that are willing to take self-directed funds, and those that, for one reason or another, maybe just aren't aware of how they do that or what that means for them when they're trying to raise
Mhm.
capital through the marketplace. So maybe, can you give us a 30,000 footer from a manager's perspective of what does that look like to accept these funds? Is there anything that they need to do differently? Is there anything they need to do to accommodate working with a custodian or trust company that might be outside of how they would typically handle non-qualified money?
Yeah, I think there's two things that you'll want to have in your offering docs, and two things from a legal tax process to know. The one is UDFI that we talked about earlier.
Mhm,
So most offering docs, if they take um, retirement account dollars, are going to have a section in there on unrelated business income tax or unrelated business taxable income and UDFI. And this is a little disclosure you need to have in there that basically says, hey, if you're a retirement account investor, we may have this tax. You're going to need to work it out with your tax professional, just so you know you've gotten the disclosure. And it's on the account investor to know what they're doing. And then they got to determine how to deal with that tax. But the fund doesn't pay the tax. It's not a consequence for them, you know?
mhm,
So it's just for the investor. And then you got to let the investor make up their mind of, okay, is this fund still a good deal, given, they may be using debt to leverage their investment, and I might have to pay some tax on the UDFI at some point. So that's one consideration, and that's a real one. The second is, if 25% or more of the assets are quote unquote plan assets, there could be fiduciary liability or fiduciary responsibility you have with the funds. However, in the real estate space, there is something called a REOC, or real estate operating company. So let's say I end up raising 40% of the money from retirement accounts in my fund. Well, I have to deal with this plan asset rule that says you're a fiduciary. However, if I'm a REOC, which means 50% or more of my assets are invested in real property, um, and held for investment, not like I'm going to immediately sell it that same year, but it's held for investment, I'm exempt from that responsibility. So I think in the real estate space and in the venture capital space, they have a VCOC, venture capital operating company. And so, they have an exemption out of it too. And we see a lot of IRAs
Mhm.
go that way. So from a fund manager, if you've ever been told, oh, you're going to have fiduciary liability, there's a plan asset rule. If you're like, no, I'm a real estate fund, I'm going to have 50% or more of our assets in real estate, you're going to be exempted out of that anyways.
And are there other, I know, like annual statements of value reporting requirements? Is there anything from an ongoing basis that a manager would have to be concerned with?
Yeah. So typically an IRA is going to need to have an annual fair market value. So they want an indication of what's my IRA worth. Now, I'll say this just because I see the industry, and before I started my own company, I was outside counsel for almost a third of the space, and so as an attorney. So the IRS has basically said unique or hard to value assets like a private investment, that you just have to use their best efforts to update your account value every year. So now what every IRA custodian, us included, is going to do is tell their customer, hey, what's your account value? You have this investment in ABC limited partnership. What is that worth? And we generally want them to tell us, it's worth X, Y, here's what it is. But they only know if the fund manager tells them.
Mhm.
So that could just be a letter that says, here's what our estimate of what the fund is worth right now. And that can be used to update the value. It's not like you got to go get a full blown appraisal or something like
Mhm.
that, attesting to what the value is. So you will have some questions from IRA account holders asking for the valuation on an annual basis. They can get away with not having it for a few years. But eventually it's something you're going to need to be able to produce again, even if it's just on a letter.
Mhm. And now you brought up a point earlier there too of as a manager having some of these language, some of these clauses and disclosures in your offering documents. Are there anything
Yeah.
is there anything else that as an investor looking into some of these deals, if they're going to place qualified money, retirement money into some of these deals, is there anything else in the documentation or in the setup or any conversation that they should be having with a manager of making sure that they're all on the same page with what that might take going forward?
Yeah, it depends on everyone's situation, but the first one to be the debt that we've talked about. Is there debt in the
Mhm.
deal or not? And actually 401ks, solo 401ks, which many of those get self-directed to, those are exempt from that debt, actually, the UDFI tax on debt. So IRAs are subjected to it, but 401ks or employer-based plans are actually exempt from that tax. So just a little side note. Um, if someone's a little older, that's sometimes, we do have many accounts, people in their 60s and 70s. And if they have a traditional account, they may need to start taking required minimum distributions when they hit 72. So if it's someone a little older that has a traditional account, Roth accounts are exempt from these required minimum distributions, but they may need to make sure they're getting some income from the fund or have other retirement account money to satisfy their required minimum distributions. So, when you hit 72 and you have a traditional IRA, let's say up to $1 million, or 100,000, doesn't matter. You're going to have to take about 3% of that out as a distribution, when you hit 72. And then it starts going
Mhm.
up over time to you're maybe taking 6 or 7% out. But so if I have a $100,000 account, I need to get 3,000 out that year as a distribution. So if the fund's not distributing profits and I invested every penny of my account into that deal, I could have a problem from a required minimum distribution standpoint. So
Mhm.
that's one thing an investor should be thinking about if they're older, using traditional funds because Roths are exempt from RMD. Um, but otherwise, it's just the typical due diligence, from the
Mhm.
investor standpoint is look at the deal, look at the returns that are being discussed, do your own numbers and make your own analysis as to it. Don't just trust the fund sponsor blindly, but look at it and come to your own conclusions. And then if it's better than the next best thing your retirement account can invest into or what it's already in, then you should be investing, right? I mean, why would you not? um, the thing I'd say though for a fund sponsor, if I could mention for them, back on their consideration is, we had it was a hedge fund, not real estate, but they basically are a hedge fund that invests in different index funds in and out,
Hmm.
and had their own little proprietary trading strategy. They'd had individual investors for years and done pretty well at it. They had a good track record, had 1,000+ investors, and they'd been at it for 5 to 10 years. They'd been shy about using retirement accounts, and they ended up opening up their next fund to retirement accounts. And all they did was went to their existing database of people who'd already invested with them and said, hey, you can invest in this one. And by the way, the next fund we're doing, if you want to use an IRA, you can. Almost half their dollars came in from retirement
Wow.
account. And they were so shocked because this was just their existing database of people.
Hmm.
And, we ended up working with them and setting up hundreds of accounts for people investing into their funds. So I think for a lot of people that raise money, it's like, don't think about going to someone else necessarily. It's your existing database of investors or prospective people that have looked at you and considered or invested with you to say, and did you know you could use your retirement account in this offering?
Hmm.
Um, and because there's just so much money socked away there that frankly, a lot of people are frustrated with the returns they've got. I can't tell you how many people I talk to that are like, the market's up, but why isn't my account? Like, what the hell? Or it's like, I hear the market's up, 15% this last year, but my account's up 5. It's like, well, when you peel away the onion and all the fees and everyone else you got involved in that account because you wanted to just be set it and forget it, that's what happens.
Yeah. And now I guess so to that example you just brought up there, the timing thing, from an investor's perspective, if it sounds interesting, when should they be doing this? Is it when they find an ideal investment, then start that process? Is it something they should set up? If this sounds interesting, get it set right now so they can act when they see that investment. Like, how do you feel about the timing or phasing of getting this set up to a self-directed?
It depends on what they're doing. If someone's going to invest into they're looking more for a private fund, that can be done in 2 to 3 weeks.
Hmm.
So we can get an account set up next day on with us. So you just go online. We have an online DocuSign app for it. But then you got to move the money over. Let's say it's at Fidelity. Well, Fidelity takes 3 to 5 business days to get your money over here. Then you've got subscription documents you're doing. And so there's a little bit of process on it. So, but you don't need to like get it over here and set up and just sit here in cash until you find it. You could stay invested in something if you want. We do see many people open up an account and just wait till they have an investment and they transfer funds over when they have the investment.
Hmm.
What I do recommend though, for someone, if they're going to do their own deal directly, they're buying a single family rental or they got a large account, they're doing a smaller multifamily deal or commercial, whatever, is get that structure set up with at least the amount of money you need to get the property under contract and make an earnest money deposit. Because especially in this real estate market right now, if you're doing the deal yourself and it's not investing in another fund, like you're tying up the contract, like you're doing all the work and you got to move fast. So you need the account going. If you're using an LLC in the process where the IRA owns the LLC, you'll want that set up and you want to fund it. You don't have to fund it with everything to buy the deal, but you want it funded enough with enough money to just, get a down payment or make an
Hmm.
earnest money, whatever's going to be required to get the deal under contract. And then you move the rest of the money over when the deal is ready to fund and close.
Okay. And then fees. I know that's one of probably the biggest complaints that we get from people when they're looking at doing these in self-directed with custodians is
Yeah.
just fees. Um, see, generally they seem quite a bit higher than most people would like to pay generally,
Yeah.
as with most fees. What are your thoughts there? I mean, have you guys seen fee compression in the space as more people get? Is it becoming more competitive? What's your general, how do you see fees playing into this and how should an investor consider that when they're looking
Yeah.
at different options?
Yeah, I mean, we've seen fees be a concern. One of the reasons I started my own company doing this was I was just really appalled by the service that was provided. Someone was
Mhm.
trying to do a deal and they were tied around with forms. It seemed like these custodians were operating in the 1990s still, like with their process and procedures. They didn't have e-sign capability. They were just like super old school. And the big companies in my space still are, sadly.
Mhm.
Um, So
we
it's
just
great for me, I
we
guess.
still just recently were allowing for electronic signatures, right? For the longest time, up until a couple of years ago, you couldn't electronically sign your account opening documents, right? It had to be a wet signature. So definitely hopefully getting with the times with some of the other providers out there too.
Yeah, and so, we've embraced certainly the e-sign, even for
Hmm.
authorizations to invest and things like that, account opening. Like we kind of treat it like, what would we want if this was our account, and I self-direct my own account here. And so we're always very focused on making it easy for the client. But the fees has been a big rub.
Hmm.
Many of the bigger custodians in our space have a fee based on the size of your account. And someone with a $300,000 account or more is going to be paying like $700 at some of these places. And
Hmm.
we see clients moving over that are paying over $1,000 a year for their self-directed account. That's insane. Um, our annual fee is $295. And every time you make a new investment, it's between $50 and $100, to process the investment. We don't have any per asset fee or an account based on the size of your account. It's just a 295 annual account fee. Now, if you want to wire or something, it's $35 more. Checks are free, but so there's some little fees there. But with us, once you buy something, you're paying 295 a year.
And do you see more going towards that flat fee kind of a structure?
There's some, but not necessarily more. You still see a lot of trying to hold on to what they call the total asset value, TAV, in our
Hmm.
space. And it's really from the financial services industry carryover of kind of an assets under management type fee model. And so I just don't think it works because frankly, it dissuades some of the larger accounts, which are the accounts we love. Because it's like, well, they're going to pay 3 to 4 times more for $1 million account somewhere else, and they're going to pay here. Where we love those accounts. They're usually savvy customers and know what they're doing. So yeah, I just think when we built our fee model, we built it for the customers we wanted. We wanted to attract the right customers, still obviously make sure there was some profit in our business model. But I think something over 500 a year, like I don't know. I don't that seems a little high for me to
Hmm.
why they would need to charge that much a year. Because once you've made the investment, there's not a lot going on, right? There's some
Right.
tax reporting on your account, there's some statements being done. When you set up your account and make an investment, there's a lot of work. There's a lot of paperwork and process and procedure to get it funded. But once it's sitting there and maybe there's some income coming in, getting deposited, I think 295 is a pretty reasonable fee for the customer and for the company.
Good. Anything else that we want to touch on with either the manager side tapping into this capital or the investor side looking to tap into their retirement accounts?
What I just see on the manager side is let the investor decide where they should put their money. I think some managers have taken the stance of, well, I think it's just better they invest their personal dollars. Okay. I mean, maybe you don't, and maybe some people are like, I can raise enough money from my network or, with just individual dollars. I don't need to tap into retirement accounts. Well, remember, there's not any fiduciary liability to you. So if someone's preached to you that, don't worry. You're a real estate operating company. 50% or more of the assets that the company holds is real estate. You're exempt from that anyways. Um, and I just say that let them decide. There's so many people out there that have retirement accounts that are dying to do this stuff. They
Hmm.
have a high level of interest, or that when they find out about it, are going to be so excited that they can do that because they've worried about their retirement account and have been annoyed with the performance of it. And they're like, finally, I can invest in this stuff that I've used my personal dollars for because I was interested in with doing it with my personal dollars. So let them make the determination of, what's right for them. I mean, I think fund sponsors aren't advising them on what to do with their money anyways. They're just
Hmm.
giving them the opportunity. Let the investors decide. But remember, there's $30 trillion out there in retirement accounts. And for someone that needs to grow more and wants to raise more capital, it's where the money's at.
Agreed. Well, Matt, I think that's a great spot to end today. Wait, let listeners know how they can find out more about what you guys are up to.
Yeah, go to directedira.com. Directedira.com is our site. Accounts can be set up online within 24 hours. We have our podcast there, directedira.com/podcast. It's also on all the, podcast channels, iTunes, Spotify, Stitcher, we're everywhere. And then, yeah, just let us know if we can be of service. That's our expertise. We have a lot of resources, FAQs, white papers on our site. We actually have a white paper on real estate that I think's a really good breakdown, 5 to 6 pages on how retirement accounts can invest in real estate. That could be a good resource.
Perfect. And we'll have links to all that in the show notes. So Matt, with that, we'll wrap it up. Really appreciate you coming on today. Hopefully we'll make it less than 2.5 years next time before we get you back on the show.
All
Thank
right.
you for sharing everything with us today.
Okay. Thanks, Adam. My pleasure.
All right, listeners, that's all we've got. As always, if you have any comments or feedback, please send us a note to podcast@realcrowd.com. And with that, we'll catch you on the next one.